Let's get some instant reaction to all of this from David Doyle. He's head of economics at Macquarie. And David, obviously, with a survey like this, ahead of an inflation report for Canada tomorrow, I think a lot of people are trying to get a sense on what this all means for things like interest rates in Canada. What was your reaction to these surveys from the Bank of Canada?
Look, John, as you were speaking to the results, I couldn't help but think this is uniformly exactly the kind of release that the Bank of Canada is looking for in order to proceed with interest rate cuts. So I think by and large, all the data or most of the data that are included in that report, could be used by Bank of Canada later this month in order to cut rates by a further 25 basis points.
And I believe these surveys were conducted before the Bank of Canada cut their policy rate at their June 5th meeting. So, whether or not actually seeing a rate cut starts to influence sentiment in the surveys themselves, I guess the themes that were building up that led to the Bank of Canada cutting interest rates in the first place are front and center in these kind of surveys.
Yes, that's right. So I think the survey reflects, most of May in terms of when the results were gathered and presented. So they wouldn't yet reflect the impact from the rate cut that occurred in early June. But I think by and large, it's moving in the direction that we would expect, given the slow growth, given the rise in the unemployment rate. I think it's in line with that, and given the softer economic growth we've experienced.
Now, on the subject of wage inflation, which we've talked a lot about throughout this inflation watch, sticky inflation, if prices all around us are going up and the labor market is somewhat resilient, people might ask for a wage increase, and why wouldn't you? But then, of course, you worry about the inflationary story. But this quarterly Business Outlook survey reporting that the pressure employers are facing from labor shortages is weakening to a 15-year low. Can you explain the dynamics as far as you understand there?
Well, look, I thought it was interesting. Not only did that labor shortages, or the share that saw labor shortages weaken significantly, but also that the expected wage growth number that the firms are looking at came off significantly. So I think that was above 4% in the latest Business Outlook survey. And then with this one released today, it went to close to 3%. And that would be more in line with what Bank of Canada sees as being consistent with its 2% target.
Okay.
I think more broadly, when you look at wage growth, I think a lot of the recent increase has come more so from unionized workers and from public sector workers. So that could explain some of the discrepancy we've seen between these survey results and the actual wage data that comes out every month.
I guess if there's an expectation among businesses that we're going to see a slowdown in wage increases, the idea, it's always been tricky in this whole narrative, is do we see an outright slowdown in the economy? I mean, we'd already seen some cooling for Canada's economy, opening the door to rate cuts, but nobody wants to see, a recession. So what's your sense on where the economy is headed from here overall?
Look, I think what we've seen and what the most significant development has been in recent months has been the rise in the unemployment rates. The rise in the unemployment rate sitting at 6.4% today, that suggests that the output gap has widened, and the widening output gap is leading to reduced inflationary pressures, exactly what the Bank of Canada is looking for. Now, is that consistent with a recession? Well, I think the dynamics that Canada has experienced so far, and even going back to 2023, was that we had such strong population growth that you could have still employment gains, but a rising unemployment rate and still rising or okay real GDP growth. I suspect that as we move forward, what you're going to see is weak real GDP growth, so something maybe at 2% or below, but nothing that would suggest that you see a contraction. And the reason for that is the Bank of Canada now has the policy flexibility and is beginning to ease.
And when it comes to consumer behavior, because I think we've all experienced this in this inflationary period, where sometimes it just feels like you have to accept sticker shock. Things seem a lot more costly on a lot of fronts these days. But it seems like the survey results are citing consumers maybe switching to less expensive products. Maybe they're being a lot more vigilant in searching for discounts, almost saying no to some of those higher priced items. And I wonder what the catalyst for that, in your opinion, might have been. Is it the fact that maybe the unemployment rate is going up? Is it the fact that because of this higher interest rate environment, people already have to deal with, whatever it is, a higher mortgage or whatever, that, they're going to be vigilant because they have no choice?
Yeah, so I think the weakness in the labor market is most likely a contributing factor, but I think the bigger thing that you alluded to there was mortgage rates. And in fact, mortgage rates resetting higher, as they are for a lot of Canadians today, and something that should persist through 2025 and even into 2026, The way that we see that hitting the economy most significantly is through consumer spending. So Canadians will prioritize their mortgage payments. They'll make them if they can, but where they'll cut back more so is on those discretionary spending items.
Okay, so looking ahead, we do have an upcoming Bank of Canada interest rate decision. We saw a June cut. It seems like there's a reasonable number of economists on Bay Street who would not be surprised to see a cut in July. What is your thinking, and is your thinking going to be further influenced by the inflation numbers we get tomorrow?
Yeah, I mean, we'll respond when that data comes out. But if that data is in line with expectations, which is our base case, then we believe they will proceed with another 25 basis point cut. I mean, I think the data overall over the past couple of months has been somewhat soft. I think in particular, the labor force survey for June, which showed the unemployment rate ticking up by another couple percentage point, or 0.2 of a percentage point, that will, make the Bank of Canada feel as though easing again in July is the appropriate course of action.
I mean, I remember early on in this rate hike cycle, the warnings that you had about Canadians and Canadian debt loads and how things might play out for Canada's economy. But you started this conversation by highlighting that for the Bank of Canada, these trends all seem to be fairly encouraging. So for all the freakouts we've had about how we would navigate through this, do you think we're navigating through it relatively well?
It feels that way at the moment. I feel like I should be knocking on wood, as I say that.
This plexiglass.
Yeah, the fact that inflation has come in so significantly, and central banks, not just here in Canada but around the world, feel as though they have the ability to start to lower policy rates. That, in our view, reduces recession risks compared to where we were 12 months ago or 18 months ago.
And I know you're not a stock market strategist, but we see that theme in the U.S. as well, where you've had a relatively resilient economy, but now they're talking about interest rate cuts, which sometimes cuts signal that you're going to see a huge deterioration in the economy, but maybe there too they're going to be navigating it closely.
Yes, and some of the best equity markets returns occur during these soft landing episodes where you have what I would call a best of both worlds, where the central bank is lowering the policy rate and yet the economy remains in expansion.
All right.